Next, we discuss the profitability ratio in detail. What is meant by profitability ratio? Profitability is a measure of efficiency and control. It indicates the efficiency or effectiveness with which the operations of the business are carried out. Poor operational performance may be result in poor sales, thereof low profit. Low profitability may be due to lack of control over the expense, result in lower profits. Profitability ratios are employed by the management in order to assess how efficiently they carry on the business operation. How are we calculating the gross profit ratio? The gross profit ratio expresses the relationship between gross profit on sales and the net sales. So we calculate the gross profit ratio by gross profit divided by net sales into 100. We can get the gross profit ratio. The gross profit would be the difference between net sales and the cost of goods sold. How we calculate the cost of goods sold? Opening stock plus purchase plus all the direct expenses relating to purchase minus closing stock, we getting the cost of goods sold in order to calculate the gross profit ratio. Gross profit is calculated by net sales minus cost of goods sold. There is no standard format for the GP ratio for evaluation. A higher ratio indicates the better positions. Next, net profit ratio. Net profit is a good indicator of the efficiency of a firm. Net profit ratio is determined by relating the net income after tax to net sales. How we calculate the net profit ratio? Net profit after tax divided by net sales into 100, we get the net profit ratio. A high ratio indicates the better position. There is no standard format for the net profit ratio. Next, operating ratio. Operating ratio is computed by dividing the operating expense by net sales. Operating cost divided by net sales into 100, we get the operating ratio. How we calculate the operating cost? Cost of goods sold plus operating expense. It includes both administrative expense, selling and distribution expenses are come under the operating expense. So we get the operating cost by cost of goods sold plus operating expense. Non-operating expenses such as interest charges, tax, etc. are excluded from the computation of the operating ratio. Operating profit ratio. How we calculate the operating profit ratio? Operating profit divided by net sales into 100, we get the operating profit ratio. The operating profit is calculated by gross profit minus the operating expense, or operating profit calculated in another manner, net sales minus the operating cost. How we calculate the operating profit? Net sales minus cost of goods sold plus administrative and office expense plus selling and distribution expenses. According to the questions, we may adopt any one of the formula. And what are the things to be given in the questions? According to that, we adopt which kind of formula. And the high ratio indicate better to its. And next one is the return on capital employed. It indicates the percentage of the return on capital employed in the business, and it can be used to show the efficiency of the business as a whole. Return on capital employed we calculated by net operating profit divided by capital employed into 100. So we get the return on capital employed. Return on capital employed is equal to the share capital plus reserves and surplus plus long-term loans minus the non-business assets plus fictitious asset, or equity plus non-current liability, we get the return on capital employed. Or otherwise, we calculate by total assets minus current liability. Operating profit is the profit before interest and tax. Next is the return on owner's equity. This ratio helps to the shareholders of a firm to know the return on investment in terms of profit. How we calculate the return on owner's equity? Net profit after interest and tax minus PE divided by owner's equity into 100, we get the return on owner's equity. This is the single most important ratio to judge whether the firm has earned the satisfactory return for its equity shareholders or not. Next is the EPS, earnings per share. It measures the profit available to the equity shareholders on as per bias, the amount that they can be get on every share held. It is calculated by dividing the net profit after interest and tax minus PD divided by the number of equity shares, we get the EPS, earnings per share. The EPS is the ratio is an important index because it indicates whether the wealth of each shareholder on per share basis has changed over the period. The performance and the prospectus of the firm are affected the earnings per share. If earnings per share increase, there is a possibility that the company may pay more dividend or issue bonus shares. Next is the dividend payout ratio. This ratio measures the relationship between the earnings belonging to the ordinary shareholders and the dividend paid to them. It can be calculated by dividing the total dividend paid to the owners of the earnings available to them. The dividend payout ratio is calculated by dividend per equity shares divided by earnings per shares. Next, the return on total asset. How we calculate the return on total asset? The ratio is computed to know the productivity of the total asset. It can be calculated by net profit after interest and tax divided by total assets into 100. Next, the return on shareholders fund. This ratio is calculated to work out the profitability of the company from the shareholders' point of view. Return on shareholders fund is calculated by net profit after interest and tax divided by the shareholders fund into 100. How we calculate the shareholders fund? Share capital plus reserve is equal to the shareholders fund.